Are you looking for a smarter way to trade? Want to know how to increase your earnings in the financial markets without relying on luck or guesswork? In this video, we're going to uncover one of the most reliable tools in a trader's toolbox, candlestick patterns. By the end, you'll understand what they are, how they work, how to read them, and most importantly, how to use them to grow your profits and reduce your losses. And remember, if this video gets 1,000 likes, I'll release a full step-by-step guide on how to start day trading from scratch. Let's dive in. A candlestick is a visual tool used in technical analysis to show the price action of an asset within a specific time frame. Could represent 1 minute, 5 minutes, 1 hour, a day. It's up to you depending on how you trade. Each candlestick gives you 4 crucial pieces of information like the opening price, the closing price, the highest price during that period, and the lowest price during that period. This makes candlesticks far more informative than a regular line chart, which only shows closing prices. With candlesticks, you can actually see the battle between buyers and sellers, who's winning, who's losing, and where momentum is shifting. Now let's break down the parts of a candlestick. There are 2 main parts, which are the body and the wick or shadow. The body shows the range between the open and close. If the close is higher than the open, the body is green or white. That's a bullish candle. On the other hand, if the close is lower than the open, it's red or black. That's bearish. The upper wick shows how high the price went, and the lower wick shows how low it dropped during that period. These wicks are very important. A long wick shows that price moved far from the open or close. It might mean rejection or indecision. For example, a candle with a long upper wick shows that buyers tried to push the price higher, but sellers pushed it back down, a sign of possible weakness. The shape and length of the body and wicks give you insights into market psychology, who's in control, and what might happen next. Candlestick patterns are so powerful because they are visual footprints of market psychology. When you look at a pattern, you're seeing how traders are reacting to price levels, to news, to emotion. You're seeing fear, greed, confidence, and doubt, all packed into a candle. Some patterns tell you when a trend might reverse. Others tell you when a trend might continue. By recognizing these patterns, you can enter and exit trades at the right time, and you can set tighter stop losses whilst increasing your profit potential. Let's now look at 4 of the most effective candlestick patterns, one by one, and I'll explain exactly how to spot them and how to trade them. The hammer is a bullish reversal pattern. It usually appears at the bottom of a downtrend, signaling that sellers may be losing control. It has a small body at the top, long lower wick, at least twice the size of the body, and little or no upper wick. The psychology behind it is that the price opened and dropped heavily as sellers dominated, but then buyers stepped in with force and pushed the price back up near the opening level. This creates a candle that looks like a hammer, and it signals that buying pressure is returning. You can trade it by looking for support levels or waiting for confirmation by using the bullish candle after it. You can set your stop loss below the lower hammer. A crucial thing about trading is that it's not only about seeing the pattern, it's about the context in which it appears. The shooting star is the bearish cousin of the hammer. It appears at the top of an uptrend and signals a possible reversal. It has a small body at the bottom, and it has a long upper wick which is at least twice the size of its body. Sometimes it has little to no lower wick. This trend is created when buyers pushed the price high, but couldn't hold it, and sellers came in strong and pushed the price back down near the opening position. It's a sign of rejection at higher prices, and usually means a trend is weakening. You can use it by looking for it at resistance zones or after strong bullish moves. You could also wait for a red candle after it to confirm the setup, or consider taking profits or placing a short position. This is a 2-candle pattern, and it's very reliable when spotted correctly. Here's what happens. The first candle is small and bearish, whilst the second candle is large and bullish. The green candle completely engulfs the red candle's body. It shows a shift in momentum. Sellers were in control, but buyers stepped in hard, reversing the direction. It's especially powerful at the bottom of a downtrend or near support. You can trade it by confirming with volume or RSI rising, or by entering at the close of the green candle or on a break of its high. Place a stop below the pattern. This pattern gives you confidence that a reversal is real, not just a pullback. This is the opposite of the bullish engulfing. It signals that buyers have lost control and sellers are taking over. You can spot this trend by noticing its first candle, which is small and green. The second candle is large and red. The red candle engulfs the green candle's body. When this appears after a strong uptrend, it's often a warning that the market is about to reverse. You can ride this trend by looking for it near resistance. Also, use confirmation, such as a break of the red candle's low. Place your stop above the high of the pattern. Pair this with volume spikes, RSI divergence, or key news events for even stronger signals. These patterns aren't just for decoration. They're tools to help you increase your earnings. By learning when to enter and exit a trade based on candlestick confirmation, you're no longer guessing. You're making data-driven decisions. You can ride trends longer, avoid early exits, avoid bad entries, and even scale in with confidence. And when combined with strong risk management, candlestick patterns become income tools, not just trading signals. Let's face it, losses happen, but your job is to control them. Here are some simple methods to prevent losses. The first one is the easiest and most effective, and it involves always trading with a stop loss, as it can help you and prevent your account from blowing. You must never risk more than 1 to 2% of your capital on a single trade. And also avoid overtrading and emotional decisions, as they can lead to impulse trading, which is not great. The use of simple candlestick patterns with other tools, and not relying on one signal, can help you improve your earnings. And finally, learning from your mistakes and seeking help from others. Preventing losses is just as important as making profits. Thank you for watching. If you found this valuable, hit that like button, and remember, if we hit 1,000 likes, I'll create a complete, beginner-friendly tutorial on how to start day trading, step by step. Thanks for watching, stay disciplined, and I'll see you in the next one.